guys, welcome back to this session. Now we are getting to know the second line for today's chapter. Now the first line we get to know is the capital market line. It is being put into the same dimension as efficient frontier, with x-axis being the standard deviation, with y-axis being the expected return. Now comes to the second line for today. It is the security market line, and it is a linear and graphic form of the CAMP. Now, the risk measurement in CAMP is different from CML because the relevant risk measurement is the market risk sensitivity, which is beta. So that means if we want to put security market line into a dimension, the axis needs to be the beta. Capture the market risk right here. Now, similar to capital market line, the intercept on y-axis is the risk-free rate because this is the level of return we are going to get if we do not undertake any market risk. Now, different from the capital market line, other than the risk measurement, the security market line can travel to the second quadrant. That is going to happen when we have a single asset that has negative beta. So that's how these two lines are different from each other. Now, this security market line offers the required return when we're taking on a certain level of risk. And we can see that the beta equals to 1 leads us to have market return. Well, this is because the market portfolio itself has a perfect and positive correlation with itself. So it offers the market return right here. Now, the practical sense of security market line is that we can plot the actual return for a single individual asset into this dimension. If we find the individual stock return landing on the lines here, it means that this security is currently correctly priced. And if we find a dot that is above this line, it means that it represents a higher level of efficiency compared to the security market line. It offers a higher level of return given its perceived level of risk. Now, that indicates that in later times, the market is gonna realize this misprice. It's gonna realize that this stock was more than it currently was. So the price of this stock will go up. Now, we want that in our investment. We want to purchase a stock that is going to rise in value. However, if there is dot above the security market line, there is going to be dot below the security market line. It means that the current observed return is lower than its level of required return. So that means this price is currently overvalued. So that's why it offers a return lower than the required return. So the market, when it realizes this, it will correct this misprice. It will lead to the next price equilibrium, which will have a lower price. So we do not want to put our money into a stock that is going to lose its value in later times. So when we do investments, what we want is we find dots at least on or above the security market line. So we are going to observe an increase in stock price in the future time. Because they are undervalued, they need to increase their stock price. We do not want to invest our money into undervalued asset because it is going to drop in its price in later time. Now, when the market is in equilibrium, then every single asset will be sitting just on the security market line, indicating that we won't be able to have excess returns. We can only get what we deserve. We are getting the risk-adjusted return just on point. Now, let's see an example. Now, our broker advised that there is a promising stock of Bella, and he advised that the price of this stock is going to rise from $20 to $22.50. And that is the advised return proposed by our broker. Now, we also have information on the market index, that's market return 11.25%, and the T-bills rate, which represents the risk-free rate, and that's 4.75% per year. And we are using the average from the last 10 years. Now, we say that the beta for Bella is 1.25. So will us purchase this stock? Now, the solution of how we solve this question is how we apply the CAMP function. We use the risk-free rate and the beta and the risk premium. That's the difference between the market return and the risk-free asset. We use them to calculate the required return for this Bella's stock, and we compared this level of return to the advised return given by our broker, and we compare these two to see if the advised return is higher or lower than the required return. Now, let's look at how we solve this question. Now, we use the CAMP function. That's the risk-free rate, that's the beta, that's market return, minus the risk-free rate right here. And then we can calculate the required return of Bella's stock as this much, approaching to 13%. Now, let's see what is the advised return given by our broker. So we use the ending value minus the beginning value, and then divide it by the beginning value. We get the rate of return as, well, lower than 11%. So that means the advised return is lower than the required return. If we see the advised return in relation to security market line, it will be a point below the security market line, indicating that it is currently overstated in terms of its value. So it is going to have a price drop in the future. We do not want to put our money in that investment. Well, if it's the other way around, if the advised return is higher than the required return, which means that the stock is going to appear above the security market line, then we are likely to purchase this undervalued asset. Now, let's see some variations in security market line. Now, let's first see what is going to happen if a dot moves along this security market line, or what leads to these movements. Now, if a firm changes its risk exposure to market turbulence, it is going to move its positions on security market line. If there is a change in industrial production or legal environment, if it pushes up its operation obstacles, it is likely to increase the uncertainty it faces. So it might lead to a, let's say, a move up position along the security market line. If there is a lower exposure to the market risk, then there is a going down movement right here. So this happens, the dot movements along the line happens when the individual company change its risk exposure to market turbulence. Now, let's see what lead to the change in SML's slope, the security market line slope. Now, we can see that if there is an increase in the slope, it means that for the same level of market risk, the new security market line indicates a higher level of required return. It happens when the investors change their risk tolerance level. Well, because there's no change in the risk level and the required return level change. That can only happen when people change how they feel about the exactly same level of risk. So if investors become more risk adverse, they become more sensitive to risk increments, then the increased slope in security market line is going to lead to a higher level of required return, which fit the need of investors. Now, that holds when there's only change happen to investors' investment attitude. Now, it is more likely to be psychological based. And let's see if there is a parallel shift in the security market line. What is the trigger? Now, the intercept here is the nominal risk-free rate. That is the compensation for our time value of money during the investment and also our compensation for facing inflation. Now, a parallel shift happens when there is nothing else change. The only changes happens to the level of nominal risk-free rate. Say there is a change in the expected inflation, or there's a change in the, well, let's say there could be a change in the time value of money, which is more likely an indication of long-term economic growth. Though the variations in long-term economic growth is lightly presented compared to the change in inflations, especially during relatively short time. So if a parallel shift happens, it is more likely to be led by a change in inflation. So if everything else holds, then we are going to observe a parallel shift when there is a change happened to nominal risk-free rate. Now, we have gone over several interesting features about the security market line. Lastly, we are going to see how the function of capital asset pricing model operates in realities. All right, stay tuned. See you next time. Bye-bye.